The beauty of the internet. All of humanity's problems stem from man's inability to sit quietly in a room alone.
That's right.
French philosopher Blaise Pascal. Dirk van der Walt, when I was reading through his, doing a bit of research into his life, he says he spends most of his time, his working time, looking at a blank wall. Do you do the same kind of thing? Do you spend time sitting in a room alone?
Yes. Now, I do spend a lot of time sitting alone in a room. I think that's important, quiet time alone. There's no doubt about that. You need to think through things in your mind, get them right, and put them down on a piece of paper. And you can't do that with a bunch of people around you running around shouting and stuff. But then you also have to go out and test these ideas with other people. So it's both. You can't. It's not the one or the other. And it depends on, again, it depends on your own personality. I was trying to illustrate the difference between value investors and growth investors generally is growth investors like to move in a crowd. They like to buy the popular things that everybody agrees with. And that's fine. If you can do that well, that's a good process. That's a good philosophy. Whereas value investors, myself, tend to be more isolated and alone. And you actually have to force yourself to get out there to talk to people about your ideas and that sort of thing. But it's both.
It's like David Shapiro's on TV often and you're not.
That's just because he looks a lot better than I do.
Well, I don't think he would debate that either. But when you were talking about Rebosis, I was wondering, and it brought up the idea about, and it's come through this conference a few times, financial statements. How trustworthy are they nowadays, given this number of instances of areas where they have not been giving us the truth?
Yeah, I think it's quite clear that you can't trust financial statements on the face of it. I think, as I said earlier, you have to take financial statements after studying them properly, and then go and look at the business and speak to the management of the business, and then these things have to tie up. Then they're a big help. I mean, make no mistake, you need financial statements, and probably 95% of the time they're fine and they're accurate. 4% no, let me rephrase that. 70% of the time they're fine, they're accurate, and you can work off them, and it's fine. 25% of the time they're too complex because of IFRS to even understand, so you need to go and get some help for a non-accountant like myself. And 5% of the time they are misleading. So it's not often, but they can be misleading. And the only way to find out if financial statements are misleading is to go and tie those numbers up with what management is saying and doing. They have to tie up. And if they don't make sense, then you walk away.
Steinhoff?
They didn't tie up.
How did you know it and not too many other people didn't?
Look, I can't take credit for knowing. I was highly criticized at the time for not owning Steinhoff, by the way. Most people felt I was being dumb, because there was a strong consensus out there in the market that Steinhoff was a great business. But there were all sorts of red flags, especially in the cash flow statement, over a long period of time. And the other thing that was happening was regular acquisitions and regular funding operations, either debt or equity raisings was happening. So most businesses can sustain themselves with their own internally generated cash flow and can make acquisitions and pay dividends from that internally generated cash flow. Every now and then you have to go to the market if you want to do a big transaction to raise equity via share placing or possibly debt. But those, you don't do that very often. But Steinhoff is doing it like in 1 year, I forget the number. In 1 year, I think Marcus did like 35 acquisitions, small ones and big ones, and was continually raising funding via equity and debt. And that's a red flag, number one. And then, as I mentioned, the cash flow statements never really tied up to the income statements and what was happening in the business. So I didn't know anything. There was nothing wrong. There was just red flags. And when you see red flags, you stay away. Because the thing is, you don't have to invest in everything. You should only invest in the things you understand and that you're comfortable with. And if something makes you uncomfortable, you stay away. I've been uncomfortable about many companies in the past, which has turned out to be wrong. Those companies have gone on to do wonderful things. So the fact that I didn't invest in Steinhoff it wasn't because I was a brilliant analyst and understood there was something wrong there. I was uncomfortable with the situation. There were some red flags I didn't like, so I chose not to invest. And that's basically as simple as it is.
Peter, through the work I do, I've met many people, and I have a theory that all of us are like onions. Some people manage to remove layers of the onion until they get down to perhaps the core truth is at the bottom. Now, you don't get anybody who's perfect, but you've removed a lot of layers of your onion. How?
I don't know. It's just probably years of practice, years of continual practice, and through good times and bad times. You learn to do this, and you learn not to get carried away with your own successes and your own failures, because in investing you are going to have failures as well. And if you can look at both successes and failures and understand where they come from, then I think you can deal with these layers that you speak of, and you can unpack things, and you can see things from your perspective as they are. And now everybody's got a different perspective, and mine isn't the only correct perspective, but from my perspective, I can unpack things and try and understand them as they are.
What did you learn from the criticism that you were subjected to not that long ago?
Yeah, not that long ago. Look, a lot of that criticism was justified. I mean, I did go out too far on a limb. I was not diversified enough. With the benefit of hindsight, our investment, my investment position was correct. We were heavily into resources at the end of 2015, and we were Anglo-American was trading at 50 Rand a share at the end of 2015. Today it's touching 800 now, I think. So we were right, but we were too early. And as they say in the classics, the difference between wrong and too early is indistinguishable. So what I learned from that was not to when you've got high conviction in an idea, not to go all out on a limb with client money, with other people's money, because they don't like it when it looks wrong for a while. And to be right, unfortunately, sometimes you have to look wrong for a while. And if that while lasts too long, your clients can't take it. So that was a big lesson I learned there.
You said one of the, and I've heard this for decades now from you, don't lose money. And the second point, don't forget point number one. But where do you draw the line on don't lose money? Because you're a value investor. You invest in companies who, by definition, you're never going to get the timing absolutely right. And they continue to slide, or the share prices continue to slide. Yeah. So where do you impose stop losses?
Question, yeah. No, I don't use stop losses. When you buy the shares of a business and the share price continues to go down, you can do one of three things. You can continue to buy. If you apply your research and you're sure you're right, you can continue to buy up to a point where because you don't want to, again, become too undiversified. The second thing is you can accept the share price decline and wait for it to go up again at some point in the future. Or the third thing you can do is you can redo your analysis, and if you were wrong, then you can sell. Those are the different alternatives. But the one thing, and that goes back to a quote from Ben Graham, an investment operation is one where upon thorough analysis, you can have the safety of principle. So I would say that when I do the work on each investment I make, I know that my capital at least is safe in most future eventualities. Not in all, because funny things happen, but in most future eventualities, the capital will be safe. So if you're buying something like Anglo-American in 2015, when its book value is 200 Rand, and maybe the mines are slightly overvalued in the books, but they're not way overvalued. Maybe it's only worth 150 Rand, it's trading at 50 Rand, and it goes to 30 Rand. On paper, you lost 40% of your money, but your principal, what it's worth is still 150 or 200 Rand. That's the value of what you bought. So you need to understand that. So that is not losing money. Although the share price has gone from 50 to 30, if you still own the shares, you haven't lost money. It's only if you sell them at 30 Rand that you've lost the money. And eventually, as these cycles go, and you have cycles in all companies, whether it's a growth company or a value company, so-called growth company, value, there's cycles in these businesses, and cycles are important to understand. And so if you can buy an asset which upon thorough analysis promises safety of principle, I think you haven't lost money.
Piet, I thought it was a bit of out of character when we spoke some time ago, and you said you should be putting 1 to 2% of your portfolio into cryptocurrencies. You heard Stafford this morning. Are you going to now put 3 to 4% or 5 to 6%?
No, my view hasn't changed. I mean, I agree with a lot of what Stafford said. I also, I think he painted one side of the picture. There are other sides as well. There's counter arguments for a lot of those things. I don't think it's a sure thing. I think there are problems as well. For instance, it costs a lot of money to transact in cryptocurrencies and to do transactions and to buy NFTs. The frictional costs are still very high. But that can go down. I mean, we all remember in the early days of the internet when we were dial-up modems, you'd put that telephone receiver on, remember telephones? Put the telephone receiver on the modem, and it'd take you 5 minutes and you download like 2 emails. That was the internet 20 years ago. So that can change. So there are criticisms of it right now. But I think it is an asset, crypto, with a binary outcome. It could be worthless or it could be worth a lot. How much of your portfolio you put in that? I wouldn't be comfortable with more than 1 or 2%, but that's my view. Other people have different risk tolerances and different views on that, and that's not to say that's incorrect. That's just my view.
But at least to have a stake.
I think one should have exposure to it because I think the underlying technology makes a lot of sense. Decentralization is definitely a trend that I think we should all support. I think it makes sense. So yeah, but how you do it is very important.
Now I'm pretty sure people here who came to the first and the second conference are wanting to know about your bundles and your branches in those bundles. Just explain that concept, if you would, and then update, because I've got a lot of friends who've made a lot of money out of your little twigs.
Yeah. So the way I look at my portfolio is exactly that. It's a bundle of twigs. In fact, that's the sort of, when I do PowerPoint presentations, I use that as a sort of a background. It's just a bundle of twigs tied up with a string. And if you look at each share in the portfolio, that is represented by a twig. Now each share, whether it's a blue chip or a small cap, each share is individually fragile. Things can happen to such a company which might not break it, but it could bend it, it could hurt it, it could make the share price or the value of that company go down, and the share price will follow the value down. That can happen to any individual company because of a pandemic, because of Russia invading Ukraine, because of any type of event that we just cannot forecast. You can't forecast these things. So again, the way to manage that risk is to take those little twigs and bundle them all together, tie it up, and then you come up with a robust configuration. That bundle of twigs is a robust, it doesn't break easily. Because if your portfolio is properly diversified across risk factors, across geographies, across business sectors, then when Russia invades Ukraine and Russian shares become worthless, it doesn't, your portfolio, and you have some Russian exposure in your portfolio, properly risk management, you have a small portion, and your portfolio might go down by 1% or 2%, and you're fine. If a pandemic happens and you've got a small exposure to property, your portfolio goes down by a little bit, but it doesn't carry you out. So each asset, each individual stock is a twig, and the portfolio is that bundle of twigs. And the size and the thickness of the twig corresponds to the size of the stock in the portfolio. So that's the mental construct I use to describe the portfolio. And that's why it's important to buy a portfolio of assets and not, and we'll probably talk about some shares here today, but I'm bullish on Robosis. But I could be completely wrong, and these guys could be deceiving us with a transaction, and it could turn out to be worthless. I mean, that is a possible outcome. So whichever shares I talk about here today, or in passing in our corridors, don't bet the ranch on it, because it just might not work.
How many twigs in the bundle?
At the moment, I've got quite a few. I think I'll own about 70 shares in the portfolio. That's just the African portfolio. But I've got a long tail of small position in small cap stocks, where I don't want to have a big position because you get stuck with liquidity situations, and it can become a problem. So I've got a long tail of small caps, and then some large cap stocks make up the top 10. Almost half the portfolio is made up of 13 or 14 large cap stocks.
Maybe you can just update us on a couple of your twigs that you had from the last couple of conferences.
So I think last time we spoke about Lewis was one of the companies we spoke about. Still, the guys are executing well. I think they are both good retailers and good financial service providers. They obviously lend money to their clients against the furniture they buy. They run a good book, financial book, and they run a good retail operation, which is a nice combination. The business itself is probably not financed optimally. In other words, it's probably got too much equity and too little debt on the balance sheet, but that's fine, that's conservative. Remember, safety of principle, it's important. So I still like it. It's still trading below liquidation value. You could buy, and I think I pointed out last time, you can walk in there and buy the whole business at the current share price, liquidate the company, and you'd end up with more money than you paid for it. So it's not even priced like a going concern, although it is one of the last remaining furniture retailers in the country, and there's a place for furniture retailers. Their competition has all gone bankrupt over the past 10 years. JD Group, part of Steinhoff. What's the one that African Bank bought, bankrupt? Ellerins, yeah. So the competition is gone, or by and large gone. And that's great. No supply, demand for the product, and they're doing fine. So that's one I spoke about.
Avenge
came out with results just recently, which I think the market took as disappointing. They probably were slightly disappointing. But it's, I still maintain it was trading at 5 or 6 or 3 cents, 4 cents, I don't know, around about there. It did have a share consolidation recently. I think it's probably worth 30 Rand a share now, and that translates to about, I think it was
about 6 cents.
6 or 7 cents, yeah. 6 or 7 cents. That's probably what it's worth, and as a going concern. And I think it might have a tailwind in future if some construction activity happens in South Africa. So the steel business is doing well. They're probably going to sell that, so there'll be cash coming in. So I think it's fine at the current share price, around about 18 to 20 Rand. It was up at 25 Rand at some point. I think it's still fine. I still hold it. Still own it. Baldwin has been a disappointment. It's one of those twigs that hasn't broken, but it's a bit out of shape, if I could put it that way. That one is also trading at below liquidation value. But if I look at the accounts and I look at what's happening on the ground and I look at management actions, I'm not quite happy with how things are going there. Management are too promotional, and that promotional activity doesn't reflect in the numbers. So it's not adding up 100%.
It's interesting, Johnny Rabi, you recall, he said no, he wouldn't touch it with the board.
He was right.
Yeah,
he was right.
At that point.
100% right.
Last question from my side, and then put your hand up and the microphones will come to you. You pointed out that Transaction Capital was one of your favorite stocks, and that they'd done a fantastic deal with We Buy Cars. So we had Dirk here, and I spoke to him in the preamble to I never said to him, Dirk, Piet says you guys sold too cheap. Have you had a chance to engage with him?
No, I haven't. I actually did speak to him about another matter a while ago, but no, I never had a chance to engage with him. Look, I mean, it's easy when you stand outside a business and they do a transaction to say, oh, you're selling it too cheap or too expensive, you're paying too much, whatever. So it's easy to criticize transactions from outside. But when you're in a business and you're doing transactions and you're busy buying something or you're busy selling your own business, there's a lot of factors at work. And I wasn't an insider to any of those factors that are at work. Business is a messy thing. We see share prices and names next to the share price, and the share price going up and down, and we think, that's what's happening. But it's like that duck on water, the duck's just floating along, but underneath those feet are paddling quite hectically. That's how business works. Business is hectic. And there's all sorts of things that happen which we as outside passive minority investors don't know about. So, from the outsider, to me, it looked like they sold too cheaply. Not by not by a factor of 10 or something, maybe 10 or 15% too cheap, but they sold too cheaply. But maybe there were some other things on the go there, so who knows?
Sounding board time. Would you trade a holding in, say, Wilson Bailey or Avenge for transaction capital?
No, I think they're different businesses with different drivers, and I wouldn't replace the one with the other. I think in terms of building a portfolio, there's a place for both of them in the portfolio.